This episode is brought to you by Progressive Insurance. Fiscally responsible, financial geniuses, monetary magicians. These are things people say about drivers who switch their car insurance to Progressive and save hundreds. Visit Progressive.com to see if you could save. Progressive Casualty Insurance Company and Affiliates. Potential savings will vary. Not available in all states or situations.
This episode is brought to you by Google Gemini. With the Gemini app, you can talk live and have a real-time conversation with an AI assistant. It's great for all kinds of things, like if you want to practice for an upcoming interview, ask for advice on things to do in a new city, or brainstorm creative ideas. And by the way, this script was actually read by Gemini. Download the Gemini app for iOS and Android today. Must be 18 plus to use Gemini Live.
Investies, welcome back to a new episode. It feels so good to be on the microphone with you this week. We are going to be talking about a very famous seasonal pattern known as the Santa Claus rally. If you've been listening to Investies for over a year, then you are already familiar with the Santa Claus rally. We talked about it last year. I'm going to go over what the seasonal pattern is, and then we're going to compare the performance to last year's performance and how we did. So stay with me. Let's get this conversation going. I feel a little out of place being on the microphone because it has been such a long time. I have missed you all, and I'm so happy to be here. The Santa Claus rally is a very famous seasonal pattern that takes place in the last 5 trading days of December and the first 2 trading days in January. So this year, the Santa Claus rally is set to take place on December 24th and then end on January 3rd. On average, the Santa Claus rally produces an increase of 1.3% to the S&P 500. If the Santa Claus rally realizes, meaning we actually see the Santa Claus rally take place in those 7 days, we see that 1.3 on average increase, then that tends to determine how the stock market will perform for the remainder of the year. If the stock market does not perform and we see a negative during those 7 trading days, then we can expect to see a decline in the S&P 500 for the year. The Santa Claus rally was identified by the author Yael Hirsch. He writes the Stock Trader's Almanac, where he has discovered many patterns. He discovered this pattern in 1972, and that has been taking place since 1950. In the last 5 trading days of 2022 and into the first 2 trading days of 2023, we got to see the Santa Claus rally take place, and we definitely benefited from it. So it was an excellent year in 2023. Now, for the 2023 Santa Claus rally that started in December and ended in January of 2024, not so much. The stock market did not have a Santa Claus rally, which then tells us that we would have a negative year. However, on the episode that I recorded a year ago where we covered this in January, I did state that we have a really big caveat and that we may not see the Santa Claus rally go into effect because it is an election year. And all in all, in election years, we tend to see the stock market increase no matter what. On election year, that is what we can expect. Do not confuse that seasonal pattern with the seasonal pattern that predicts who the president is. That's a completely different pattern. There's the pattern of the election year that determines that on an election year, we can expect to see positive growth. And so I was anticipating that seasonal pattern would offset what the Santa Claus pattern predicted. And that is indeed what happened. Let's take a look at where we are year to date in the market.
Welcome to What's the Best? Today's contestant is Jane. Ready to win, Jane?
Absolutely.
First question, what's the best match game?
Best Fiends?
Correct. Where can you collect the best, cutest creatures?
Best Fiends.
Right again. And now for the bonus question. Which game celebrates 10 years with 10 days of exclusive unreal gifts?
Best Fiends.
You nailed it, Jane. Tell our audience what they should do.
Download for free on the App Store or Google Play.
Best Fiends.
Ryan Reynolds here for Mint Mobile. One of the perks about having 4 kids that you know about is actually getting a direct line to the big man up north. And this year, he wants you to know the best gift that you can give someone is the gift of Mint Mobile's unlimited wireless for $15 a month. Now, you don't even need to wrap it. Give it a try at mintmobile.com/switch.
$45 upfront payment required, equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes on unlimited. See mintmobile.com for details.
Before we get into these numbers, I do want to preface this by saying that I am recording this episode on Tuesday, December 17th. And so anything can happen in these last few trading days. So keep that in mind and do your due diligence once the end of the year actually takes place. You can see how these numbers held up. Year to date for the S&P 500, we saw an increase of 27%. That is phenomenal growth. I really want to put this into perspective for those of us that are new and learning about the market. The S&P 500 on average grows anywhere from 8 to 10%. And so to see numbers like 27%, this isn't really normal. However, I do feel like we are starting to see a new pattern in the market, and it makes me wonder if our averages are going to go up. For 2023, the S&P 500 grew 24%, which again is another astonishing number. We're looking at a 3% difference. This is not normal, but maybe this type of growth is somewhat normalizing. With that being said, it is also very important for us to be very realistic. We have to understand that this amount of growth is just not sustainable. And so when I say that I wonder if our averages are going to go up, it is only because we've had several years of this crazy amount of growth. But it is not sustainable. And I do think that at some point, we should anticipate some sort of pullback and some sort of correction. On Monday for Morning Bread, if you don't know what Morning Bread is, it's a piece of content that I produce about 4 times a week, where I talk about how the stock market is performing, how it's performed for the morning, and just pieces of news that we should be paying attention to. I did talk about in Morning Bread my not necessarily concerns with the market, but I did ask investors that have been investing for at the very minimum 5 years to really take this opportunity to look at their portfolios and assess whether or not there are some stocks that they may need to trim, that they may need to sell, that have gone up exponentially and just locking in some returns. Typically, that is not really sustainable advice, but with the level of growth that we have had, I also think it's relatively responsible to take action in this way. I said a couple of episodes ago that I have been selling out of shares. I am still selling out of shares. I sold out of shares a few days ago. I have been consistently selling out of shares since August. The reason I have been selling out of shares is twofold. The market has grown exponential. The return on some of these shares is absolutely incredible. And so it's important for me to be responsible and lock in some of my gains. Now, I have also been an investor in this specific stock for 10 years. And so it's time for me to start selling. I am now considering in 2025, at the beginning of January, to sell out of my second largest position. If you've been with me for a while and you know what my portfolio looks like, some of our Patreon members do, then you know what position I'm talking about. I am considering selling out of that position in 2025. I'm not selling out of it now because I do have to be very mindful on tax implications. And I'm already taking a pretty hefty tax implication with the shares that I have sold this year. And so I kind of want to break up the tax implications. Everything is about strategy. So it is important that when I talk about these things, and the reason I don't talk about them often, or I spend more time talking about these things in private, is because I don't want to influence anyone, most especially new investors, on potentially selling out of their positions. We should be looking at investing as something that we need to do for the absolute long run, long time horizon. This is the key. The longer you are in an investment that has seen growth, the less riskier that investment is. And so as new investors, it's just really important that we maintain consistency and purchase stocks as often as our budget allows. There is a very important quote from Warren Buffett that is absolutely underrated. And the quote goes like this: "Buy stocks like you buy groceries and not like you buy perfume." What he is saying is make sure that you are consistent in your purchase. It doesn't have to be a big, lavish investment as long as it's an investment that is consistent. That is really the key to building wealth. I would never tell anyone to sell out of their positions. I do think that for some folks that have been invested in the market for over 5 years, most especially because we got to see the 2020 bubble that took place with stocks, and then we got to see the 2021 crash, it might be good to look at your portfolio and see if there's anything that you need to rebalance or trim. Because again, this amount of growth, it is not sustainable. I went off the rails there. I totally went off topic. I had no plans on talking about that, but I think it is important for us to take a look at that, considering that, we are looking at what has taken place over the years. So let me just pull it back in. We were talking about the growth that has been taking place in these last 2 years. We talked about the S&P 500. Let's go ahead and take a look at how much the Dow Jones has grown. The Dow Jones is an index that grows a lot slower. We can typically expect the Dow to grow from anywhere in between 5% to 8%. The Dow grew 15% this year, and in 2023, the Dow grew 13%. So we're seeing a 2% difference there. Now, for the NASDAQ grew 36%. We can expect the NASDAQ to grow anywhere from, I would say, 10% to 12%. Again, these are not normal increases in the market at 36%. And then if we take a look at 2023, we are looking at 44% increase. If you have been an investor in these last 2 years, then it has gone really well for you, my friend. And let's not even get into the percentages of owning individual shares, because it makes these percentages look like crumbles. If you are a direct shareholder in some of the mega caps, then you are getting cookies. Thank you so much for joining this week's episode. Let's see if we actually get to see the Santa Claus rally. Yale Hirsch has a quote that says, "If Santa Claus should fail to call, bears may come to Broad End Wall." So hopefully we get to see a little Santa Claus rally there, 1.3%. Last 5 days in December, first 2 days in January. Happy investing and happy holidays. You're listening to Investies, a Cosmic Standard and In Luz We Trust production. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.
An O'Reilly Auto Parts gift card is the perfect gift for that hard-to-buy-for person. Give the gift of convenience from O'Reilly Auto Parts.
O'Reilly Auto Parts.